Well, good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Friday. It's the first Friday of February, which is the fifth trading week of the year. Now, the markets are near all-time highs. The Dow is up about 130. The market's going to open up in about an hour and 13 minutes or so. All the futures are positive today. Now, I wanted to show you something interesting here. Jobless claims report yesterday was positive. Remember what I was telling you, expectations, consensus, the moving average? We blew right past that. And that's giving me hope, and that's giving the market hope that employment situation is getting better. We're also going to get the employment situation, not the jobless claims, but the monthly employment situation and international trades in goods and services at 8:30 in about 13 minutes or so. But I just wanted to kind of give you some expectations of what we're expecting or what the consensus is. So consensus is 50,000. So recovery in the labor market reversed in December as non-farm payroll contracted by an expected 140,000. They're looking for a rebound with a consensus of 50,000 and a low estimate of 100,000. So are we going to have a contraction of 100,000 or are we going to have a surplus of 400,000? The consensus is we're going positive. Now, based on the jobless claims report, which is a weekly indicator, this actually does make sense. But I'm going to tell you right now, if we're going to go back to 140, it's bad. It's bad. It's telling us that COVID is having an impact on the workforce. Unemployment rate, I'm expecting to be right at the 6.7%. But again, the numbers are a little, so we're going to have to be a little cautious in terms of these numbers. Because again, we're still in a very blinding situation where we just don't know where we're going to end up each week. Now, this is the put to call ratio. I want to explain this to you because this is really, really important. When you see the spikes, and usually this is a random indicator, but whenever you see a price, or this is not price, the indication move above, say the one level, that means markets are becoming increasingly fearful. That means put buying is increasing. When you see the trend move down here to anything below 0.80, that means the market's getting overly bullish. If you notice the trend over the past 4 months, and this is a 4-month chart, you will see that even the highs are getting lower. So the sentiment is moving this way. It's moving towards calls. The fear level is getting smaller, and the greed is going higher because it's moving this way. The lows are getting lower. And remember, it's counterintuitive. So the lower it goes, the more bullish the market gets. The higher it goes, means this is a very bearish market, and this is a very bullish market. And notice even the peaks, the bearish peaks are getting lower and lower, and it looks like the market is reaching a really overbought sentiment. And that's a period where the markets need to cool off. Now, in light of that, you're also seeing the Dow near all-time highs, and if I'm correct, we should be seeing the NASDAQ at all-time highs. Let's see. Yeah. Now, remember what I was showing you. This divergence, this is the RSI. The highs are getting lower. Highs are getting higher here in price, but momentum levels are getting lower. That's a sign that the market is going to contract. That's a rubber band. What you're seeing here, higher highs, lower highs on the oscillator, that's a rubber band. What you're seeing right here is a rubber band. The highs getting lower, that's a rubber band. And as I mentioned many, many times here, let me just use the NASDAQ as an example. The number of stocks you will see here above the 200-day moving average is almost at 90th percentile. And as I've pointed this out to you several times, that is the highest level we've been. Look at this. Look at that. Look back. Look at this. This is March 2010, December 2009. So we are at the highest momentum level. Put to call ratio is really starting to favor the bulls a little too much. And the NASDAQ is overbought and diverging. So overall, the market is bullish right now, but it is a little bit too bullish, and it really does need a good pullback to the 200-day moving average. And let me just show you what that would look like. Now, here's the 200-day moving average. This is a long-term chart. Let me just kind of show it you in a way you understand. there's a good chance before the summer comes that this market will pull back and hit somewhere around here, the twilight zone, as I like to call it, the distance between the 50-day and the 200-day line. So be prepared for some pullbacks. Now, before I let you go, I got some news for you, earnings news. I didn't want to do the broad market news because I do it every day, and there hasn't been much of a change from yesterday to today. Just to give you a broad view in case you tune in once a week on Friday, for example, there's still a big fear, infections in China, COVID infections in China, COVID infections in Europe are going up. There's still fear that this vaccine, that these lines of vaccines that are out right now are not going to completely prevent this new African variant. So the markets are nervous, but they are increasingly bullish. As you could see here on this chart, you could see how the sentiment, look at that, down, up. That's not happiness, folks. Now, to give you an earnings update, earnings for the fourth quarter are turning modestly positive following 3 straight quarters of declines. The shift into positive territory is there because of tech. Tech is making things really good for earnings. Estimates for the current and upcoming quarters are going up, and companies that are reporting for the fourth quarter are mostly better than expected. The positive earning trend has been in place since July. So we have been positive since July, and the market has been going up since July. But I'm telling you, it doesn't just go one way, folks. It goes up and it goes down. Now, we've had about half of the S&P report so far. So far, total earnings are up 2.5% from the same period last year, about 1.5% higher revenue. 80% are beating earnings estimates, and 78% are beating revenue estimates. Now, keep in mind, these estimates have been beaten down and down and down and down. So the fact that 80% of stocks are beating them only means they've had time to bring the estimates down. If we were looking at what the estimates were compared to a year and a half ago, you would all be very disappointed. Now, as far as tech, 75% of earnings are out. Total earnings are up 21% for tech on 12% higher revenue, which is impressive. 93% beat earnings per share, 90% beat revenue. And also we have about, we have a good amount, I don't have the exact number, but we have a good amount of financial companies reporting. Probably I would say about 50 to 60% if I had to guess. I don't have the exact number, but they're up 15% from the same period on flat revenue from a year ago. The last 3 quarters for finance was down 11%, down 45%, down 32%. So this is the first quarter in the last 4 quarters that we're seeing upside. Now, going back to the tech sector, for the fourth quarter as a whole, write this down because if the numbers don't go this way in the next 25%, then the price shall come down. So for total, for this quarter for tech, we're looking at about 19% higher revenue, higher numbers on 14% higher revenue, which follows a 12% jump in the third quarter. Other sectors that have positive earnings this quarter, you may want to write this down. Autos up 66%, medical up 11%, basic material up 23%, medical up 11%, and retail only up 11%. I was hoping that retail instead of autos would be at 60%. But hey, again, I'm going to repeat these, and this is a good place for you to start looking for opportunities. Auto sales, medical, basic materials, I've been talking for a while, medical. Wait a minute, medicals are, I said medical twice. Sorry about that. So autos, medical, basic materials, and retail. I had medical here twice. Now, looking at the fourth quarter as a whole, we're looking at flat earnings and flat revenue, which would follow a 7% decline last quarter on 0.6% negative revenue. So things are looking better, but not a whole lot better, just to give you a perspective. And remember, just because over 80% of the companies are doing better than expected, those expectations have been beaten for the last 9 months. So the companies had plenty of time to revise their estimates lower and lower and lower. Now, looking at the calendar year for the S&P 500, earnings are expected to decline 16% on flat revenue, and that follows an increase of 26% and 8%. So again, let me repeat that. Looking at the calendar as a whole, earnings are expected to decline 16% on 8% lower revenue in 2020 as a whole. Because remember, this is the fourth quarter of 2020. That's what got me screwed up. Now, 2021, we're looking for a positive increase of 26% on 8% higher revenue. So estimates for both years have been going up. So the expectation for the end of this year is positive 26%, but we're going to end this year, this last quarter is the last quarter of 2020. That's what got me confused, is negative 16% on flat revenue. So the end of this downside is, this is supposed to be the last quarter of negativity, or even last quarter, and we're now already seeing tech and finance with better than expected numbers. And again, this is where you want to focus: auto sales, medical, basic materials, and retail. Now, before I let you go, let me show you, let me just give you a good idea of the stocks that are pulling back right now. Lilly, medical stock, one of the top medical companies, pulling back. If you look at the stock as a whole, you will see that it's pulling back on a nice breakout here. We're way above the previous February high right here, way past that. And I like the stock. I would buy it near the 203.40 level, and I would put a sell stop near the 195 level. And I do like Lilly. Good stock and a good position to enter it. Lilly's a great trade, but before I let you go, I've got something important for you. Joy of the trades, Jeff Zananeri, he's finally ready to reveal his proprietary market scanner that allows him to isolate 9 trades most likely to go up every single month. Now, Jeff's been doing this for a long time. He's got institutional hedge fund experience. This guy is in the know. Each of these trades benefit from a massive wave of capital that floods the market like clockwork, giving in-the-know traders and investors the chance to make double and triple-digit gains. Who does not want double and triple-digit gains? Now, this century-old market phenomena is well known by Wall Street and usually stays between former insiders like Jeff and myself. But Jeff wants everyone to benefit from it. Jeff is pulling back the curtain on these cash floods that can give regular folks the chance to make gains of 20%, 40%, heck, even 100% or more on their trades. Folks, you don't want to miss this. This is a century-old phenomena that Jeff is going to share with you. You need to get in on this. Click on the link below to learn how you can join him and cash in on this potential paydays just like these. And make sure you like this video and subscribe to this channel if you're watching on YouTube. Stay ahead of the market by being the first to be notified when we post new videos. And most importantly, have an amazing weekend. Bye, folks. Feedback, comments. Need your feedback and comments. Bye, everyone.